The first page is the assets page, and that's page 2 of the Yellow Book annual statement. And what you need to keep in mind is these pages are structured with column headings. In this case, page 2 is going to have 1, 2, 3, 4 columns. And you can see that column 4, as you might expect, is a comparative to prior year's numbers. So it's a straightforward financial statement, much as you would expect to see. These financial statements need to be on a comparative basis, and that's where a lot of the information will come from. The assets section, what you need to keep in mind for statutory accounting, the focus is really about being able to pay claims. How liquid is the company's assets toward meeting its obligations to satisfy those potential claims. And I'm going to go through a couple of primary areas, and I'll tell you a little bit about the differences between statutory and GAAP accounting in terms of the measurement of the assets. First line that we're going to talk about is line 1, and that's bond or fixed income investments. And these, for the first difference you need to note with respect to GAAP versus stat, bonds are valued at amortized value on page 2's balance sheet. So you can see on line 1, and you can see that those bonds are at amortized value, and that's important to keep in mind because they're not marked to market. They're fixed income. The NAIC and the statutory accounting rules and principles will actually value these fixed income investments. So they're investment grade 1 through 6. If they're not investment grade, they become non-admitted. If you look at column 2 in the assets page, it refers to non-admitted assets. So non-admitted assets are an important piece of this because on a statutory accounting basis, you may have a ledger asset or an asset on your books, and if it doesn't meet the specific rules and requirements of eligibility to be counted on a statutory financial statement, it's going to be non-admitted, and you'll see that in this column if there is a non-admitted component to an asset. As we move down to line 2, stocks, and you can see that there is a preferred stocks and common stocks are noted on the financial statement as well. And the idea here is that these are marked to market. So it's fairly consistent for stocks, whether it's preferred or common stocks. They're going to be reflected at current market value on page 2, the assets page. Let's move down to line 5. You'll see that there is a line in there for cash. And so here again, it's all about the liquidity of these assets, their availability to ultimately pay claims and demands on the insurance company. Line 12 is subtotals, cash and invested assets. That's the total of all the invested assets. The next section in the balance sheet I wanted to spend a little time on is the receivables section. And here, as you might imagine, we're covering premium receivable from agents. That's what the company's business is. It's issued a policy, it's got receivables coming in on that premium. You're going to see that in this section of the balance sheet. In addition to that, you're also going to see receivables from a reinsurance company. A lot of these companies, property casualty companies, are sharing the risk with other companies. They're called reinsurers. And so if the reinsurer is sharing in the risk, they're sharing in the losses, they're also obviously going to be sharing in the premiums. So as that comes back and there are losses paid and there are recoverables out there on that reinsurance, it's coming back into the balance sheet as a recoverable or a receivable. Now, one thing to keep in mind on a GAAP versus statutory basis, if these were GAAP financial statements, the receivable from the reinsurer on recoveries from the losses that the company has paid versus what the company would pay to the reinsurer for taking that risk is netted out. On a statutory basis, they're not. The receivable shows up on the asset side, the payable to the reinsurer, the premium to settle the premiums shows up on the liability side of the balance sheet. You also have another item you might want to take a close look at on the asset side, particularly for those of you who might not see this on a regular basis every quarter or even every year. Deferred tax assets. Now, normally when people start to talk about tax calculations and things, they run the other direction. There's not a lot of complicated activity going on here. what you're seeing is a net deferred tax asset. It's an asset that can be used in the future to offset a tax liability. The first thing you need to have in the future to use that is profitable or taxable income. There's one other item on the balance sheet you might want to take a close look at, and that happens to be the receivable from parents, affiliates, related entities. In a lot of cases, when you go through an audit or a financial exam, this is one of the first areas that an auditor might look at, because if you think about it, if you've got a receivable on here from a parent, an affiliate of some nature, then there ought to be an offsetting payable on that entity's books as well. And so when you're going through a financial exam by the department, or you're going through an audit through the public audit, what they'll be looking at is, okay, we see that you've got a receivable here on your balance sheet. We're going to go look on the liability side of that corresponding entity and see if there's a payable out there. And in a lot of cases, if there are timing differences, this is the first thing they'll look at during the audit or the examination. And it's something to kind of be aware of as you're reviewing these financial statements for this company.